Good morning, everyone, and welcome to AIADA's AutoTalk. I'm Rachel Soleimani, your host for today's session. Join me in welcoming today's presenters, Amy Stillwell and Louis Fisher of Moss Adams. Moss Adams is one of our newest affinity partners, and we're so excited to have them on board. Amy is the Senior Tax Manager at Moss and serves as an integral part of the Automotive Dealer Services Industry Group. She provides tax planning and compliance services, as well as transaction structuring to companies and their owners. And Louis is the Assurance Services Leader for the firm's Automotive and Dealer Services Group. With that, I'll leave it to the pros. Take it away, guys.
Okay, morning, everyone. This is Amy. Louis, you want to say hi?
Yeah, good morning. We're excited to be here. We're excited to quickly talk through tax reform and touch on the high points.
What we really want to talk about today is the high points of tax reform and how they affect automotive dealers. So we're going to talk about important steps to take now, what to do for the future, and what is gained and what is lost. I think it's really important to note that the IRS hasn't issued any guidance yet on tax reform itself, so we're still waiting for the IRS to issue guidance. So we're going to talk really quickly about what we can do now to deal with tax reform. So I think this is the high keynote takeaway. So the tax rates went down for 2018, so we can defer income and accelerate expenses on the 2017 tax returns and create permanent tax savings. So for those of you who have not filed your 2017 tax returns, you can check with your tax advisor and ensure that you're utilizing the most efficient tax positions. Louis, do you want to add anything?
I think the exciting thing that we all are aware of is that tax rates have gone down. But as we'll get a little bit further into here, what does that mean from a personal standpoint, and what does that mean from a corporate standpoint? Because those two things have some different parameters around them. So the headline that we see is tax rates have gone down, but the actual application of those rates to us personally as dealers and then also as business owners for our business, there's some tripwires that have been laid for us with the new law. And so one of the things that Amy will delve into is just thinking about how we navigate that now in the interim time before the end of the year to make sure we don't give up any potential gains.
So I really like this slide because it shows the 2017 tax rates at the top and the 2018 tax rates at the bottom. And I think it's really key to note in the 400 to 600K range, the 35% bracket is just much smaller, and the 39.6 bracket goes to 37%. So because we have a difference in the rates, there really is an opportunity there to defer income and accelerate expenses. What we can do is implement some tax method changes. For example, if you're not already using lower of cost or market for tax or flooring credits, advertising credits, if you're not deferring those or accelerating your deductions, you're potentially losing out on $200,000. So in this example, if you change your methods for 2017 and save $2 million, the difference is a $200,000 savings. So you should really be talking to your tax advisor and really see if you're implementing the most efficient tax methods possible. There are quite a few methods available for dealers that are different from other industries. Like I said, lower cost or market, flooring, advertising credits. If you're not already utilizing those methods, you could be losing out on a lot of money. The differences between 2017 rates really do make this an opportunity to have a permanent tax savings. When I say permanent tax savings, I think it's important to note that that's the difference between deferring something over the long term and really putting money in your pocket permanently.
Amy, from a tax standpoint, how often is it that we're able to get permanent tax benefits versus just deferred tax benefits?
I mean, I think this is a very unique opportunity today. We really never see permanent tax savings. We can defer and push towards the future, but this is a unique planning opportunity that allows us to save money today that we would usually just push down the line and have to pay tax on later. So the difference in the rates in the 35, 39, 37% provide us with a unique opportunity. There are other methods that you could employ, such as deferring your prepaids and those type of things, but there's a lot of unique dealer methods that you should talk to your tax advisor about to make sure that you are getting that 2017, 2018 rate differential savings.
And so just to clarify too, and you may have said it, but the key is not to have filed your 2017 tax return.
Right. Right.
Otherwise, that would create complications and put you in a situation that these would be difficult to implement these strategies. The other thing I would just add too is that in previous administrations, when there's been tax increases, everybody seems very vigilant to understand that there's a tax increase that's occurring, and so all the planning goes into ensuring that you plan for the tax increase. We're on the flip side of that now with these permanent differences to a tax decrease, and so at times the awareness of it seems to not be as high just generally, but particularly within the dealer community. So really just adding emphasis to the fact that permanent tax difference is available, meaning the tax will never, ever have to get paid. And so there's an opportunity to put money in your pocket and to put gross profit and to let that drop to the bottom line within the dealership that can put you at an advantage over the dealer down the street from you if you're taking advantage of these steps.
Right. I mean, unfortunately, if you filed your 17 taxes, you cannot go back and amend for these type of changes. So it really is something that's available to people that haven't filed their taxes for 17 yet. I mean, there obviously are advantages in 2018, but tax reform came into place, January of 18. So some people, hadn't wrapped their head around it yet. But if you haven't filed your taxes, it's a unique opportunity to save what's potentially hundreds of thousands of dollars. So the second step to take now is looking at the tax reform as it's in place today in 2018. Most people are aware that there's a potential pass-through haircut on your taxable income of 20%. So what that means is if your taxable income was $1 million, you'd only pay tax on $800,000 instead. That's a tax haircut that's available for closely held businesses, meaning LLCs, partnerships, S corporations, sole proprietors. There are caveats to that 20% haircut. You do have to have a certain amount of wages and or fixed assets. So you need to really talk to your tax advisor, make sure that you have the right amount of fixed assets or wages. We have seen in our clients that potentially some people don't have enough fixed assets on their real estate entities. So if your real estate for your store is held in a separate LLC, you need to make sure that you have enough assets there and potentially do some restructuring in order to take advantage of the 20%. We've seen in our clients, not all of them qualify for the 20%. We've had to do some shuffling of assets and moving pieces around to make sure we get that 20%, because that's an annual 20% haircut year by year. So before the end of the year, you need to make sure that you have all of your ducks in a row for that.
And this is one of those tripwires that we mentioned a few minutes ago that's been put in place to, I don't want to say trip up the business community, but it's one of those steps that the government put in place to mitigate some of the tax benefit that would flow through. So the worst case scenario is not taking those proactive steps and then looking back after the fact and realizing you missed out because of some planning issues. So consulting your practitioner and ensuring that the planning steps are in place. One of the things that we'll chat about at the very end of this is, Amy mentioned at the beginning, the tax regulations aren't necessarily written yet. That's kind of confusing, and so we'll talk a little bit about what the difference between the tax law and the tax regulation is, because that plays into this a little bit without us having clear regulation in place as of yet.
So then we look towards what can you do to plan for the future given what we currently know. And I think the biggest question that I get, and I don't know about Lewis, but the biggest question I get is I'm seeing everything in the news that says I should switch to a C corporation. C corporations have a much lower rate than pass-through entities. And the answer is, in most cases, no. Pass-through entities, as I just said, have a 20% haircut eligibility, which decreases the taxable income. But not only that, but C corporations have 2 levels of tax, which make them prohibitive for dealers. In addition to that, dealers always sell assets instead of stock. So if you sell your stock, you have to pay tax twice, and it doesn't make sense for the dealer operator. So just to give you an example of what that would look like on an annual basis, not even taking into account a sale, if you have $2 million of business income, the left-hand column represents an S corporation and the right-hand column represents a C corporation. So with $2 million, again, that haircut is on the second line, that pass-through deduction of $400,000, assuming you have enough wages. Taxable income would be 1.6 under an S, and on the right-hand column, $2 million under a C. Taking into account all the tax and assuming you take the money out that you made during the year, you have a difference of, at the bottom line, $777,000 versus $1 million of income tax. So that's, over $300,000 of additional tax by being a C Corp under the new tax reform. So even though C corporations have a lower rate, if you're taking money out of your company, which I know all of my dealer clients do, you definitely are going to be paying more tax under a C. So it doesn't really make sense for dealers as I see it.
And so the question that would come up with this would typically be, okay, well, what if I live in a state like Florida where the state income tax isn't what you deal with in California or New Jersey or New York, for example? And in those situations, there are models that can be run that would show parity with a C Corp with a S Corp or an LLC pass-through entity. And there may be some very specific reasons why you could structure in a manner that way. The problem with that is when a new administration comes in, there's always the chance that everything could get redone again. And so you could be sitting with a C Corp and now tax law changes back and now you're at a disadvantage. And now there's rules in place that don't allow you to quickly go back to a pass-through entity. So there's quite a bit of danger that you would encounter by moving into that C Corp realm. So again, there would have to be some very specific planning techniques, and you'd have to be in a state like Florida, like Nevada, in order for this to even really begin to make sense based on the metrics that we typically see with retail automotive dealers.
Right, and just to be clear, you might be able to get close to the C corporation tax in a state with no state income tax, but upon a sale, you're probably going to pay more tax. So it's one of those things where you have to look out, into the future and see when a sale would occur. If it's, very far down the line, maybe it would make sense. But again, it's one of those things where Lewis said it's a case-by-case basis. But this is just a very, very broad approach to looking at the different rates. Obviously, talk to your tax professional about what makes the most sense for you, but I thought it would be nice to illustrate the difference in the tax rates. And since Lewis and I are in California, it was an easy example for us to provide. So another planning opportunity that I have a lot of dealer clients that are taking advantage of is a donor-advised fund. For those of you who don't know what a donor-advised fund is, it's basically a fund that you contribute a charitable deduction, a charitable asset to. It can be cash, it can be stock, it can be whatever you want it to be. But basically, the benefit of the donor-advised fund is that you contribute it to a brokerage account, and then you get the immediate tax deduction when you contribute it. And then you have the ability to control the charitable donations through the fund at a later date. So you can advise the fund, hey, I'm going to contribute $100,000 to this fund, and then down the road, maybe 1 or 2 years later, you can tell them, please give, X amount of dollars to charity Y, and then you're able to control it. But the benefit of that is you get to deduct the charitable deduction in the year that you donate it to the fund. So the reason why that's important is that now that you can only deduct $10,000 for state and local taxes, a lot of people aren't going to be itemizing on their tax returns. When I say itemize, I mean deduct your state and local tax, your charity, your mortgage. A lot of people will no longer be able to itemize. Instead, they'll have the standard deduction, which is $24,000 for married filing joint couples. So what this does is it allows you in year one to deduct a very large amount and then take a standard deduction year over year over year, and it really does save quite a bit of money. So a lot of people are really looking at this as a potential, and there's quite a bit of donor advised funds out there. All the brokerage firms have it. Keep in mind it does have to be an IRS qualified charity.
I think specifically as it relates to this, I think it's important that we do mention that we're presenting just a very small population of ideas here, but this is an idea that we would consider safe. This is not a tax planning strategy that is listed within the IRS's list of areas, tax shelters that would expose you. So with proper planning and consulting with your tax advisor, this is a safe way to properly plan your deferring income tax.
Yeah, on the scale of white to black, this is white. There's no there's no gray in this. It's very transparent and very well utilized under tax reform now that we have a limited state and local tax deduction. So a lot of folks that live in states where they have at least moderate state income tax are going to want to look at this if you are a charitable giver. So let's talk about a couple elements of what we gained out of tax reform and what we lost out of tax reform. Couple individual provisions. Gain on the sale of your home is the same as it was before. You can exclude $500,000 for a married couple or $250,000 for all others. I think what's really important to note here is the estate and gift tax. Under pre-reform, you're exempted or you don't have to pay tax if your estate is under $5.5 million for singles or $11 million for married couples, and that has increased to $10 million for singles or $20 million for couples. And this is a huge, huge planning opportunity for those that are thinking about giving gifts or how to plan for their estate. This allows us a lot more wiggle room as far as what we can do for those folks who want to start estate planning today. So this is something that if you're, in the back of your mind, you're thinking, well, what does that mean for me? I think what it means is if you're considering gifting or you're looking at your estate or you're thinking about the next generation, now is the time to act because this is a window that closes in 2025 and it goes back to the lower amount. So we really want to look at gifting if that's something that's forefront of mind. Couple small things. Under the reform, alimony is definitely changed. It eliminates the deduction for the payor and it's excluded from income from the payee, and this is for divorces that began after 2018. Moving expenses are suspended. I think most people are aware that prior to 2018, you could deduct on a mortgage of $1 million. Now, if you started your mortgage after 12/15/17, you're limited to $750,000. So it dropped from $1.1 million to $750,000 if you went into a mortgage after 12/15/17. State and local tax deduction, or what we call SALT. It's important to note that did go down. So previously, you got to deduct whatever you paid in income tax and property tax and state and local tax, and now it's limited to $10,000 all in. So your state and local taxes are limited to $10,000. That limitation does go away after 2025, but as Louis mentioned, who knows what will happen with the next administration.
And I think it's important to note, too, just on the SALT piece, you've probably seen in the news where certain states like New York and New Jersey and California have tried to get creative to find workarounds for that SALT deduction. So creating a fund, for example, in California, where you could make a charitable contribution into a state-run fund that would offset your state income tax obligation. So those things have been floated about, and the IRS has made commentary noting that they would fight that. So those tactics appear to have died down ever since the IRS spoke out against that. So there really does not seem to be any workaround as it relates to the SALT deductions. I think it's important if you hear people that are promoting tax strategies or schemes that would say, hey, we can work around this, I would be very cautious and make sure you understand the parameters there because to stay safe and follow the law, there aren't a lot of options here.
There are no options. I mean, the IRS has said very specifically that the workaround for the SALT deduction is not going to fly with them, and they're not going to allow it. I think the only workaround that I've seen come out so far, and again, we're very limited on what the IRS has said about tax reform, is that donor advised fund to sort of increase your available deductions. But as far as the state and local tax goes, we have $10,000. I would love for it to be something different, but unfortunately, the IRS is shooting down all the potential workarounds. So meals and entertainment changes for those of you who used to deduct your golfing or sporting events or your season tickets. Those are no longer deductible. They used to be 50%, now they are 0. So anything that's entertainment related that you used to run through your business is no longer deductible. Anything that you use to bring in food for your employees, that used to be 100% deductible, food on the premises. So you order food and put it in the break room. That is no longer 100%, it's 50%, but we still have holiday parties and sort of employee morale type events are still 100%. So one thing I would say here is because this has changed from food and beverages on the premises are 50, entertainment's gone, it is sort of an easy thing to do at today's date to actually set up new accounts in your dealer financial statement so you can track these differently, because I think what potentially might happen is people might group it all together and then we can't bifurcate it later. So a good step today is to set up new accounts, one for entertainment that is separate from the food and beverage on the premises, that's separate from food and beverage outside, just so you don't have to go back and change it later.
So, Amy, I have a question. If I have Lakers tickets and season tickets, and I give those tickets out to my customers or my employees, is there any opportunity to still expense those in that scenario, or is it completely disallowed?
I think that's a gray area, but I would say no. If you have purchased season tickets and you take it upon yourself to give them away, that's not promotions, that's entertainment expense. But we haven't seen any guidance from the IRS on this yet, but as it sits today, I would say no. Okay, so bonus depreciation is the last thing we're going to talk about in this section, and it is a really important piece for dealers. So stores that have floor plan interest expenses do not qualify for bonus depreciation. So it used to be that you could write off 50% of the purchase price of your assets when you purchased them. So if you bought something for $10,000, you could immediately expense $5,000. That is no longer the case for dealers. So they are no longer eligible for bonus depreciation. But what we do have as a potential workaround is a Section 179 depreciation deduction, and that is just a different kind of depreciation. So under the new law, a taxpayer can expense up to $1 million of Section 179 depreciation. So there are things you can do to work with your tax preparer to know how much assets you're purchasing, to make sure you're maximizing your 179 depreciation, and looking at potentially moving bonus depreciation out of your store, putting it in your real estate potentially, and making sure that you are taking advantage of that 179 while still potentially using bonus in your real estate entity. So I think it's important to note that bonus still applies to your real estate entity if it's separate and distinct legal entity, but your store, your S Corp, your LLC, whatever function you have it in, was not eligible for bonus depreciation, and this is a huge loss for some of our dealer clients that were potentially depreciating their loaner vehicles. So going forward, beginning in 2018, entities that have floor plan interest aren't eligible for bonus. So it's important to sort of plan today for the fact that you don't have bonus depreciation in 2018.
Just a quick question, Amy, as relates to cost segregation studies, because I know a lot of dealers utilize cost segregation. Is cost seg not relevant anymore, or is that still something that they should be looking at in light of this new law?
Right. So a cost segregation study is something where you look at your real estate entity and you look at your land and your building and your improvements, and you bifurcate those pieces and you maximize your depreciation. And I think that's going to be huge going forward in 2018, because what it does is it allows you to break up those pieces into more tax advantageous depreciation expenses. So I think given the tax law and the fact that bonus depreciation isn't going to be available, cost segregation studies are going to be a huge tax savings for dealers, because they'll want to look at smaller assets and breaking up those pieces and maximizing their depreciation deductions.
So one of the things we talked about at the beginning that I think is good to define here at the end is the difference between the tax law and the tax regulation. And I think most people don't. The assumption is the tax law has been written and passed by Congress, so things are done, and the framework is what's the problem. So, Amy, could you just maybe give a quick rundown on what
Sure.
difference between the tax regulation and the law?
So, I mean, the IRS code and what is passed by Congress are two different things, but they are similar. So Congress went through and they passed all these laws which go into effect and are applicable, but the IRS hasn't come out and issued guidance on those laws. So as they're written, there's sort of an open interpretation today because the IRS hasn't issued any guidance on them. So they are truly in place, but the guidance from the IRS hasn't come out yet. So we kind of, as it says today, have some wiggle room or some, so we can kind of do what we want at this juncture until the IRS issues guidance. Obviously, there are some things that are black and white and some things that are gray. So I think it's important to talk to your tax advisor about the things that maybe aren't so clear right now because the IRS hasn't issued guidance on them and see if there's anything that you can take advantage of.
And I think that's a fascinating way to end because it's just a reminder that the tax law has been passed, but really the lobbying effort isn't done yet because it's career bureaucrats essentially that are now going to really dictate how this gets implemented amongst the dealer body. So, the lobbying continues in ensuring that those bureaucrats at the IRS don't do anything that would impact us negatively. There still needs to be influence placed upon them. So it's just fascinating to see how the process works.
Thanks, guys, for your insight into this very relevant and important topic. Again, we're really happy to have you as an affinity partner. As far as AutoTalks go, for anyone on the line, we have some really exciting programs coming up. On August 21st, Kerrigan Advisors will be on to discuss how trade tariffs could impact your dealership valuations. And on September 18th, we have Federated Insurance talking dealership succession and estate planning. So be on the lookout for promotions on how to register for them. For more information about AIADA, visit AIADA.org or call 1-800-GO-AIADA. Thanks for joining us and have a great day.